experts joining us to tell us, to guide us as to what we should look at in the budget. Chetan Ahya, co-head of Global Economics and Chief Asia Economist Morgan Stanley, has joined us, as has Dinesh Kanabar of Dhruva Advisors. Gentlemen, thank you very much for this full and extremely enlightening house. Chetan, what's the one number you will look at? 3%?
I guess, yeah, that's the most important number. We are expecting 3.3. So we think they will try to probably boost expenditure somewhat. Because remember, we don't have the revenue support from excise on oil. And, underlying adjusted for the revenue measures, the growth rate for indirect taxes is roughly around 8% right now, which the Ministry of Finance discloses. So the revenue line will be a bit tough. So in that context, I'll have to do some bit of compromise and forecast something like 3.3% fiscal deficit.
Mr. Kanabar, good morning. As Chetan says, tax giveaways are tough, but the market is expecting something. What is most likely and practical?
So, two things. First is there is some degree of unbudgeted revenue which has already come in terms of the income disclosure scheme, where a disclosure of about 60,000 crores was made, resulting in a tax of about 30,000 crores. Some question marks on how valid those numbers are, but leaving that aside, really we have some gains sitting out there. Second, through the year, we have had buoyancy on excise on oil, etc. So those numbers are there. Also, Lata, one of the things which seem to be missing out, really, which is quite clear, is the money which has come in the system as a result of demonetization is going to give a robust tax next year. And that's something which we need to budget. We cannot ignore at all. Clearly, the expectation is a reduction in the rate of tax, and I would be very, very disappointed if there is nothing on that score. Whether it
You
will
mean
come
corporate tax?
Corporate tax. Whether it is in the form of taking away the surcharges or whether it is in the form of a 2 or 3% reduction remains to be seen. And the other thing, of course, which you and the market and all of us are looking forward to is the capital gains syndrome. I don't know where is that going to go.
Yeah, Dinesh, good morning. But what's the best possible outcome from capital markets point of view? 2 or 3 things are being discussed. Long-term capital gains period being raised from 1 to 3 years. That, I think, is something the market could still take in its stride. The other issue is whether there could be tinkering with the short-term capital gains tax itself. Your thoughts on that?
So, 2 parts to the question. One is you are saying that long-term capital gains period being extended is being taken in the stride. There itself, the question is how is it implemented? Prospective versus retrospective. Yes. So, if I held something already for a period of 14 months, 15 months, and today it is long-term, when I transition, will there be a transitionary phase where I'll be protected if I have completed my tenure?
Anecdotal evidence is that it's retrospective because of what happened with the debt funds.
That's right. So, is that the form, or will they go back and say that your gains up to 31st March will be protected as long-term and therefore not taxable, and with the future gains, if you do not complete that period, will be short-term? Remains to be seen. Variety of issues out there. On the short-term, I would really say that there is a definite move to say there is no need to give a lower tax regime for short-term and should be taxed as business income.
Okay. That would be palatable. But Chetan, how do tax buoyancy add up for the next year? You won't have the oil largest. And speaking of this demonetization gains, at the moment we really don't know how much of it will stay as taxes. Growth is not really a given. How are you looking? What kind of a revenue growth or a tax growth number you will say is credible?
So we are right now building in the adjustment that I mentioned about the tax measures not being there, oil excise being not there. We're building in a 13% growth in tax revenue, which compares to close to 17% which we're expecting in March 17. So we will see a deceleration because we don't have some of these one-off big measures. So if that is a number, then it will look credible. The nominal GDP growth should be around close to 12%. So with that kind of nominal GDP growth, the 13% tax revenue growth should be fine. And we do expect them to increase service tax. So that will help them somewhat, in addition to the fact that you have nominal GDP growth revenue. Then, by the way, nominal GDP growth, or if you look at the industrial production nominal output, that is picking up now with WPI normalizing. So that should give them some additional support on tax revenue growth compared to last year. So a 13% number should be credible.
And finally, a big bank recap number would be a big positive, or a bad bank. What would be positive?
So as you know that right now they have sort of built in a 10,000 crore number. So if they build in another 25,000 crore like last year, that would be, I think, taken very positively by the markets, because 10,000 crores in the context of the fact that NPLs are rising and the capital needs are rising for public sector banks does seem low. So, as you know, sometime back we had done work on this, and we were basically saying cumulatively they need something like $40 billion, the state-owned banks, to recapitalize. So in that context, if you do not even $2 billion, 10,000 crores is not really enough.
All right, gentlemen, that's a lot of numbers you've put on the table. Thank you very much for joining us. We have to go